Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to analyze Tesla stock. I'm going to explain why I think Tesla stock is likely undervalued now. More importantly, I will talk about Tesla's biggest risks to consider and Tesla's long-term growth prospects going forward. If you have been following my channel, you will notice that I like to invest in the best companies only when they're undervalued, or at least when they're fairly valued. I like to be very greedy when the market is very pessimistic. So the best time to invest is when the market is very pessimistic because the stock is likely undervalued compared to its intrinsic value. And the best time to sell is when the market is too optimistic and euphoric because the stock is likely way overvalued compared to its intrinsic business value. In this case, I believe Tesla is somewhere between the panic stage and the hopelessness stage here. The market is being too pessimistic and too short-term focused on Tesla's margins and Tesla's vehicle delivery growth again. If I'm right about Tesla's long-term growth prospects, then Tesla's margins and EV business will eventually recover. Of course, past performance does not guarantee future results, but I still want to show you this past performance here. Tesla did underperform the other Magnificent 7 stocks by a lot over the past 1 year, but over the longer term, Tesla did fairly well compared to the rest Magnificent 7 stocks over the past 5 years. So in this video, I'm going to explain why I think Tesla is undervalued now. More importantly, I will explain why I believe Tesla's business will eventually recover over the long run. First, I will give you a quick stock portfolio update. You will see the companies I'm investing over the long term in one of my stock portfolios. After that, I will talk about Tesla's 3 biggest risks to consider, Tesla's long-term growth prospects, Tesla stock valuation, and will I buy Tesla stock? If you like this channel, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent investing reviews and stock analysis videos a week that will help you become a great investor. Each video usually takes me 20 to 30 hours to make, so if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help our members become millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing in for the long term, follow my personal stock portfolios, watch my investing tutorial videos, and download the latest intrinsic value calculators for all the stocks I'm analyzing, so you will know when a stock becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. Before talking about Tesla's biggest risk to consider and its long-term growth prospects, I want to give you a quick stock portfolio update. This is from my stock portfolios. I always show this portfolio in many of my videos to show you my investing strategy over time. This stock portfolio has done very well over the years because I have invested in some of the best companies that are the market leaders in their industries. For example, you can see that I have invested in Apple, Adobe, AMD, Amazon, ASML, Google, Microsoft, MasterCard, Visa, and Nvidia. I bought most of these stocks when they were much more undervalued before. The only company that's down temporarily right now is Tesla. I'm not too worried about this because I believe Tesla's business will eventually recover. Over the past 1 year, I sold these stocks and made these realized gains. For example, I did sell some Tesla shares before and made this realized gain. My long-term investing strategy is to look for the best businesses that have great long-term prospects, large economic moats, great management teams, great products and services, increasing earnings, and increasing free cash flows over time. This strategy has worked very well for me for many years. Once I found a great business I really like, I always use this intrinsic value spreadsheet to calculate the stock's intrinsic value. Then I just keep buying the stock over time whenever it dips below its intrinsic business value, so there's a good margin of safety to reduce risks. This is to make sure I'm not overpaying the stock. For example, back in 2022, when most tech stocks were greatly undervalued, I kept buying more Microsoft shares because I knew Microsoft was substantially undervalued. The market was too pessimistic and very short-term focused, so I took advantage of the market. Now Microsoft has become the most valuable company in the world, just surpassing Apple recently. At the time of making this video, I think the market is very pessimistic and too short-term focused on Tesla's headwinds again. I think the market is ignoring Tesla's long-term prospects again. So what are Tesla's biggest headwinds and risks right now? Here's Tesla's first biggest risk. As you may already know, Tesla has been lowering Model 3 and Model Y prices since 2022 when the Fed started raising interest rates aggressively. Lowering prices impacts Tesla's margins a lot. This is why you can see Tesla's gross margin and operating margin have decreased a lot since the end of 2022. Typically, most buyers rely on car financing to buy Tesla EVs. But car loan rates are still very high at around 6% to 7% right now, so Tesla has to keep lowering Model 3 and Model Y prices and keep finding ways to reduce manufacturing costs in order to make Model 3 and Model Y affordable. As long as interest rates are still high, Tesla will need to keep Model 3 and Model Y prices low to increase EV demand. This applies to all the car makers. Tesla is not the only company that's greatly impacted by high interest rates. This means we can expect Tesla will still have very low margins throughout 2024 and even 2025. One of the positive things about Tesla is that Tesla has a lot of cash on its balance sheet. For example, at the time of making this video, Tesla has around $29 billion in cash and only $5 billion in debt. This means Tesla can pay off all its debts and still have around $24 billion of cash left. Just like traditional car makers and EV makers, Tesla's business is very cyclical. Tesla's EV business is largely affected by the global economy. Global EV demand has slowed down a lot in recent quarters because of high interest rates around the world and because of very slow economic growth in countries like China. China is the largest EV market in the world. China is Tesla's second biggest market after the US. When interest rates are high, such as in the US, or when the economy is not doing well, such as in China, consumers have to prioritize their spending on their homes, rents, and food, instead of upgrading their cars and buying EVs. Realistically, we have to wait for interest rates to drop a lot before EV demand starts recovering. Tesla presented this in its most recent earnings release. I think this suggests that Tesla's revenue and vehicle delivery growth will continue to be very low throughout 2024 or even 2025. Our company is currently between two major growth waves. The first one began with the global expansion of the Model 3 and Y platform, and the next one we believe will be initiated by the global expansion of the next generation vehicle platform. In 2024, our vehicle volume growth rates may be notably lower than the growth rates achieved in 2023, as our teams work on the launch of the next generation vehicle at Gigafactory, Texas. In 2024, the growth rate of deployments and revenue in our energy storage business should outpace the automotive business. Here's another risk we should consider. Tesla faces a lot of competition, especially from the Chinese EV makers. BYD is Tesla's biggest EV competitor in China, as well as in the international market. BYD is expanding to Europe, South America, and many other Asian countries. If you look at the latest data here, you can see that BYD's battery electric vehicle sales have surpassed Tesla in the most recent Q4 quarter. This year, BYD will likely become the largest EV maker in the world because BYD sells many more EVs at different price range that are much cheaper than Tesla's Model 3 and Model Y. For example, if you look at this latest data here, you can see that BYD offers many more EVs and plug-in vehicles compared to Tesla. Again, most of BYD's EVs are much cheaper than Model 3 and Model Y. This is why BYD has been growing much faster than Tesla in recent years. Right now, the Chinese economy is not doing well at all. The Chinese real estate market is in a huge slump. Consumers are slowing down their spending. China's economic recovery is much slower than expected, and the youth unemployment rate is very high in China. This is why EV demand has slowed down significantly in China. The Chinese EV market is well saturated. Chinese customers are also very price sensitive. Tesla has to keep lowering prices in China in order to compete with BYD and other EV makers there. Here's another important part you should know. Based on what I know, only BYD can compete with Tesla's large economies of scale in the mass manufacturing of EVs. BYD has a huge cost advantage compared to Tesla. BYD is one of the largest battery makers in the world. Typically, EV batteries can cost between $5,000 and $20,000. BYD makes its own batteries and its own chips. This is why BYD can often sell its EVs, which are much cheaper than Tesla's Model 3 and Model Y. Elon Musk said this about Chinese EV makers. While our observation is generally that the Chinese car companies are the most competitive car companies in the world, so I think they will have significant success outside of China, depending on what kind of tariffs or trade barriers are established. Frankly, I think if there are no trade barriers established, they will pretty much demolish most other car companies in the world, so they're extremely good. In the long run, I think only Tesla and BYD can compete with each other because these two companies have the largest cost advantage and the largest economies of scale in mass manufacturing EVs. Other EV competitors such as NIO, Li Auto, XPeng, Rivian, Lucid, General Motors, Ford, and even Volkswagen cannot compete with Tesla and BYD in pricing because they sell much less EVs each year and because they do not have very large economies of scale yet. There are other risks and negative news that are affecting Tesla right now. For example, Elon Musk's $56 billion compensation package was recently struck down by a Delaware judge. Tesla's board of directors approved Elon Musk's compensation package back in 2018. Also, the Wall Street Journal pointed out that Tesla's board members are not independent at all. The journal reported that Tesla's board members have very close personal and financial ties with Elon Musk. Tesla's board members have received millions of stock options over the years. This is my prediction. I believe all these negative news targeting Elon Musk are only short-term headwinds. I don't think they affect Tesla over the long run. Tesla's board of directors may have to negotiate another compensation package for Elon Musk that would be much more reasonable. Personally, I don't think Elon Musk will walk away from Tesla because he still has most of his net worth in Tesla, even without this very large $56 billion compensation package. Elon Musk needs Tesla to succeed so he can use the stock options to fund other future projects, such as colonizing Mars and building an AI company that can compete with OpenAI. Let's talk about Tesla's long-term growth prospects here. I believe there are several catalysts that will help Tesla's EV business and margins recover over the next several years. Here's the first catalyst. I showed you this earlier. Tesla's gross margin and operating margin have decreased a lot in recent quarters because Tesla has been cutting prices to increase EV demand since 2022. High inflation and high interest rates have a huge impact on EV demand. I believe Tesla's margins will recover over the next several years once the Fed starts cutting interest rates. Here's the deal. Tesla started a price war back in 2022 when the Fed started raising interest rates aggressively. All the EV makers, including BYD, have paid the price because almost all of them have lowered their prices many times since Tesla started lowering prices. Even though BYD is selling more EVs than Tesla, BYD's margins are expected to be lower over the next several quarters because of the current price war and because of lower EV demand in China. This is why BYD was down a lot more than Tesla over the past 1 year. I want to share this article with you. It indicates how long the current price war will likely last. According to this article, a BYD general manager for branding believes that prices will remain low for 2 to 3 years. He said, many brands that are unable to compete in the market will be eliminated. This is my prediction. I believe it will take Tesla's margins at least 2 to 3 years to recover. The Fed will need to lower interest rates before Tesla's margins start to recover. Once car financing rates are much lower, Tesla will likely increase prices again, which will improve Tesla's margins. The Fed is planning to cut interest rates starting in 2024. Then the Fed is planning to cut rates even more throughout 2025 and 2026. So once the Fed starts cutting rates, we can expect all the car financing rates to be lower. This will increase the demand for EVs because many customers are waiting for lower rates before upgrading their cars to EVs. Elon Musk said this about Tesla's margins. If the interest rates come down quickly, I think margin will be good. And if they don't come down quickly, they won't be that good. It's always important to remember that the vast majority of people buying a car is about the monthly payments. It's not that people don't want. We have lots of people who want to buy a car but simply cannot afford it. And as interest rates drop and that monthly payment drops, then they're able to afford it and they buy the car. It's pretty straightforward and there are no tricks around to get around this. Here's the second catalyst. Elon Musk talked about Tesla's biggest competitive advantage over the long run and Tesla's next-gen car platform. He said, several years ago, I said perhaps the most important competitive characteristic of Tesla in the future will be manufacturing technology, and you will really see that come to bear with our next-gen vehicle. The first manufacturing location for this will be at our Gigafactory and headquarters in Austin, Texas. And then we follow that up with other locations around the world. Probably the factory we'll build in Mexico will be second. And then we'll be looking to identify a third location, perhaps by the end of this year or early next outside of North America. As of now, Tesla has a very large cost advantage and large economies of scale compared to most EV competitors. For example, Tesla's cost of goods sold per vehicle has decreased a lot over the years. Now, Tesla's cost per vehicle is around $36,000 per vehicle. This is a huge cost advantage for Tesla. Most EV makers have a much higher cost per vehicle compared to Tesla. This is why Tesla can often lower prices and still make a profit. I said this earlier, based on what I know, only BYD has a bigger cost advantage than Tesla in mass manufacturing of EVs because BYD makes its own batteries. Tesla is planned to start producing the next-gen vehicle in the second half of 2025. Volume production is expected to start 1 year later, assuming there are no delays. I believe the next-gen vehicle platform will be the biggest growth driver for Tesla over the next 5 to 10 years because this vehicle will target mass consumers. This vehicle will be much more affordable than the Model 3 and Model Y. The Cybertruck is still a very important product for Tesla, but it's more expensive than the Model 3 and Model Y. Tesla's next-gen car will be much more affordable for mass consumers and is expected to cost around $25,000. Tesla is planning to use new manufacturing processes and technologies that will make its cost per vehicle much lower, so Tesla can still make a profit by selling a $25,000 EV. BYD has been growing much faster than Tesla because BYD's EVs are generally much cheaper than Model 3 and Model Y. So once Tesla starts selling a $25,000 EV that's much more affordable than the Model 3 and Model Y, I believe many customers will switch from internal combustion engine cars and other brands to Tesla's next-gen vehicle. This is why I think Tesla's revenue growth and vehicle delivery growth will eventually accelerate again, especially after the Fed starts lowering interest rates, which will increase the demand for EVs. Tesla has other major AI projects such as the Tesla Optimus AI bots that could become a bigger market than the EV market, and the Dojo supercomputer that's used for computer vision video processing and AI training. But in the short term, I believe Tesla's biggest breakthrough is still its full self-driving FSD service. Let me explain here. Right before I started making this video, Tesla released its full self-driving FSD beta version 12 to employees and a few customers for testing. If you want to learn about Tesla's FSD beta version 12, you can go to this YouTube channel to watch the videos. In my opinion, I think this is a huge breakthrough for Tesla because the FSD beta version 12 appears to be almost fully autonomous without human interaction in many driving conditions. This is a huge upgrade compared to the previous FSD versions. Based on what I know, the new FSD Beta V12 uses end-to-end neural networks and AI to drive the car. This is very different compared to the previous FSD versions. The previous FSD versions rely on more than 300,000 lines of C++ codes to control driving behaviors, and these driving behaviors were often not natural. But this new FSD Beta V12 relies on AI and neural nets to drive the car. You can see driving behaviors seem to be much more natural, almost like a human drives a car. FSD will improve a lot over time because it's trained on data from over 1 million Tesla EVs. I think it will be very hard for competitors to copy Tesla's FSD service because they will need hundreds of thousands of EVs to collect driving data. Tesla has already collected more than 700 million miles of driving data. FSD will improve much more over time because of all this driving data and AI training. This is my prediction. I think it will be a matter of time before Tesla achieves level 4 or level 5 full autonomous driving. Once FSD is out of beta, I think many Tesla customers will still subscribe to Tesla's FSD service even if it costs around $200 or more each month. FSD should improve Tesla's gross margin over the long run. I want to show you this consensus revenue estimates from Seeking Alpha. Tesla's revenue is expected to slow down in 2024. Then Tesla's revenue is expected to accelerate again in 2025 and later. I believe Tesla's revenue and vehicle delivery will accelerate again once the Fed starts cutting interest rates and once Tesla releases the next-gen vehicle that will be much more affordable for the mass consumers. In terms of EPS forecast, Tesla's EPS growth is expected to be very low in 2024 because Tesla will likely keep prices low in 2024. This is at the cost of margins. After the Fed starts lowering interest rates, Tesla's margins should improve over the next several years. This is why Tesla's EPS is expected to grow much faster starting in 2025 when interest rates are expected to be much lower. I want to show you how to calculate Tesla stock's intrinsic value here, so you will know when Tesla becomes undervalued, fairly valued, or overvalued. If you want this calculator, you can download it from my Patreon blog. The link is in the video description. These are the key assumptions in this calculator. First, I define Tesla's intrinsic value as its future free cash flows discounted to the present day. I used a discount rate of 11% here. You can use a higher discount rate here if you want to be more conservative. Based on the risk and the long-term prospects I talked about earlier, I believe Tesla's revenue will grow at a compound annual growth rate CAGR between 12.5% and 17.5% annually over the next several years. This is slightly lower than the Wall Street consensus revenue forecasts I showed you earlier. Let's go over these three case scenarios here: worst case, normal case, and best case scenarios. Under the worst case scenario, we're forecasting that Tesla's revenue will grow at a CAGR of 12.5% over the next several years. If we forecast Tesla's free cash flow over the next 5 years and discount the free cash flow to the present day, Tesla's intrinsic value should be around $700 billion for the entire company, or $200 per share. I'm giving this scenario a 25% probability here. Under the base case scenario, we're forecasting that Tesla's revenue will grow at a CAGR of 15% over the next several years. Then Tesla's intrinsic value should be around $777 billion for the entire company, or $222 per share. I'm giving this scenario a 50% probability here. Under the best case scenario, we're forecasting that Tesla's revenue will grow at a CAGR of 17.5% over the next several years. Then Tesla's intrinsic value should be around $861 billion for the entire company, or $246 per share. I'm giving this scenario a 25% probability here. If we add all these numbers here, Tesla's intrinsic value should be around $223 per share. I also used the forward price to sales valuation model here to estimate Tesla's intrinsic value, which should be around $855 billion for the entire company, or around $245 per share. If we take the average of both valuation models here, I believe Tesla's intrinsic value should be around $234 per share. Just to compare, Morningstar gave Tesla a lower fair value of $200 per share. This means I believe Tesla is undervalued at the time of making this video. So will I buy Tesla stock? Yes, I will likely buy more Tesla shares over time as long as the stock is undervalued. There are several reasons. First, I believe Tesla's margins will recover over time once the Fed starts lowering interest rates starting in 2024. Tesla's next-gen vehicle should drive Tesla's revenue growth and vehicle delivery growth over the next 5 to 10 years, because it will be much more affordable than the Model 3, Model Y, and the Cybertruck. FSD should improve Tesla's margins once it's out of beta. I also believe that Tesla's cost per vehicle will continue to decrease over time because of Tesla's large economies of scale and because Tesla will continue to improve its manufacturing processes to reduce cost. This is my strategy. I did sell some Tesla shares before and took the gains. Once Tesla recovers to nearly $1 trillion, I may consider selling some shares to take the gains. Then I will likely invest the gains in more undervalued stocks. Now, all these are only my opinions and my analysis based on my research. They are not financial wise. There are always risks associated with investing. I think it's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.